Purchasing power parity theory. This theory hinges on the law of one price, which suggests that in the long run, real exchange rates tend to stay stable. Essentially, if foreign prices rise faster than domestic prices, the nominal exchange rate adjusts accordingly. But it's important to note that these adjustments can take a long time and aren't always perfect. So predicting short-term rates isn't feasible with. Let's dive into the core idea behind purchasing power parity, which is the law of one price. This concept says that identical goods should cost the same across countries, assuming no shipping costs or trade barriers. To compare prices fairly, we convert them into a common currency. For example, after converting Swiss francs into US dollars, machine tools should cost the same in Switzerland and the US. This sets the foundation for understanding exchange rate behavior. Building on that, the law of one price relies on profit-seeking behavior. If machine tools are cheaper in Switzerland than in the US, after currency conversion, exporters would buy in Switzerland and sell in the US to make a profit. This activity pushes prices up in Switzerland and down in the US until prices equalize. So, market forces tend to enforce this price parity over time, aligning exchange rates accordingly. However, in reality, the law of one price doesn't always hold perfectly. Trade barriers like tariffs can create price differences between countries. Plus, transportation costs limit how much profit can be made from arbitrage. These factors create wedges between prices, meaning identical goods might not cost the same everywhere, which complicates the direct application of purchasing power parity. Now, let's connect inflation rates to purchasing power parity and long-run exchange rates. The theory suggests that changes in relative price levels between countries drive exchange rate movements over time. If domestic inflation exceeds foreign inflation, the domestic currency tends to depreciate by that difference. Conversely, if foreign inflation is higher, the domestic currency appreciates. This helps explain currency value trends in the long run. Supporting that, countries with lower inflation rates generally see their currencies appreciate, while those with higher inflation experience depreciation. This relationship aligns with purchasing power parity predictions. So, inflation differentials are a key factor influencing exchange rates over extended periods, reinforcing the link between price stability and currency strength. Most analysts apply purchasing power parity to overall price levels rather than individual goods. They look at market baskets measured by indexes like the Consumer Price Index. The theory of relative purchasing power parity states that exchange rates adjust over time to reflect differences in inflation rates between countries. This means currency values tend to change at a rate matching the inflation gap, providing a broader perspective on exchange rate behavior. Here's an example to illustrate this. If US inflation exceeds Switzerland's by 4 percentage points annually, the dollar's purchasing power falls relative to the Swiss franc by that amount. Consequently, the dollar should depreciate roughly 4% per year against the franc. On the flip side, if US inflation is lower, the dollar would appreciate. This shows how inflation differences translate into exchange rate movements. The purchasing power parity theory can also be used to predict long-run exchange rates mathematically. By comparing price indexes from two countries over time and using a base period exchange rate, we can estimate where the exchange rate should move. This approach helps quantify how inflation differences influence currency values, providing a framework for long-term forecasting. For example, if the US price index doubles from 100 to 200 while Switzerland's remains at 100, and the base exchange rate is 50 cents per franc, the new equilibrium exchange rate would be $1 per franc. This reflects a 100% inflation increase in the US compared to no change in Switzerland, showing how inflation impacts exchange rates quantitatively. Maintaining purchasing power parity means the dollar must depreciate by the inflation difference to keep its relative value. In this case, 100% depreciation from 50 cents to $1 per franc is required. If instead Switzerland's inflation doubled while US inflation stayed constant, the dollar would appreciate to 25 cents per franc. This demonstrates how inflation dynamics shape currency values. While purchasing power parity offers useful insights, it has limitations. It doesn't account for investment flows that can influence exchange rates. Choosing the right price index, like consumer or producer prices, and selecting the base period can also be challenging. Additionally, government policies such as trade restrictions can disrupt the theory's assumptions, making real-world application more complex. Moreover, purchasing power parity is more reliable for long-term forecasting than short-term predictions. In the short run, exchange rates are influenced by many factors beyond relative prices, so the theory's predictive power is limited. Over time, exchange rates reflect not only price levels but also productivity, preferences, and trade barriers, making the long-run perspective more comprehensive. Shifting focus to short-run exchange rates, we see that fluctuations often exceed what fundamentals like price levels or productivity can explain. Exchange rates can change significantly in a single day, but these fundamental factors usually don't vary that quickly. This suggests other forces are at play in the short-term foreign exchange market, requiring a different analytical approach. To understand these sharp short-term fluctuations, we need to look beyond traditional factors. A framework that captures the reasons behind rapid exchange rate changes involves considering investor behavior and market dynamics. This helps explain why exchange rates can swing sharply over days or weeks, even when fundamental economic indicators remain stable. In the short run, foreign exchange markets are largely driven by investors trading assets like treasury securities, corporate bonds, stocks, and real estate. Interestingly, only about 2% of foreign exchange transactions are tied directly to trade financing. This means that asset market decisions, rather than import-export demands, play a dominant role in determining exchange rates over short periods. According to the asset market approach, investors weigh two main factors when choosing between domestic and foreign assets: relative interest rates and expected changes in exchange rates during the investment period. These considerations influence demand for currencies and cause the short-term fluctuations we observe in exchange rates, highlighting the importance of financial markets in currency valuation. Exchange rate overshooting is a key concept explaining short-run volatility. When expectations about future market fundamentals change, like monetary policy announcements or fiscal changes, investors adjust their views on future exchange rates. This leads to immediate, sometimes exaggerated shifts in currency values, reflecting how sensitive exchange rates are to news and policy signals in the short term. Overshooting occurs when the initial exchange rate response to a fundamental change is larger than the long-run adjustment. This means exchange rates can jump sharply before settling back over time. This phenomenon helps explain why we see such dramatic daily currency movements. It also reflects that short-run elasticities in demand and supply are smaller, causing more pronounced immediate reactions compared to the long run. To sum up this concept, short-run exchange rates can overshoot their long-run equilibrium levels due to market reactions. The graph illustrates how supply and demand curves differ in elasticity between short and long runs, causing exchange rates to temporarily move beyond their stable points. This overshooting effect is crucial for understanding the volatility and rapid changes we see in currency markets day to day. Let's focus on the purchasing power parity theory, which plays a crucial role in understanding exchange rates. Developed by Gustav Cassel, it was designed to estimate equilibrium exchange rates after the disruptions caused by World War I. What's important here is that it connects price levels across countries to exchange rates, helping us grasp how currencies adjust when trade and prices shift globally. There are two main versions of this theory: absolute and relative, each offering a different perspective on currency valuation. Diving deeper into the absolute version of purchasing power parity, it states that the exchange rate between two currencies equals the ratio of their price levels. In simple terms, if one country has higher prices than another, its currency should adjust accordingly to maintain balance. The formula R equals P over P star